One of the biggest shocks I see business owners face is this. They sell their business, celebrate the sale price, and then realize that hundreds of thousands, sometimes millions, are going straight to tax. But here's the truth. Some business owners legally pay zero capital gains tax when they exit. And the difference usually comes down to two things. Understand capital gain tax concessions for business owners and planning well before the sale actually happens. Hi, my name is Helen Nan. I'm a certified finance planner and author of a finance book. Information I'm sharing today is general advice only, not personal advice. Please make sure you read the full disclaimer below. In this video, I will walk you through how capital gain tax strategies can dramatically change your outcome, two real-world case studies, and when exit planning should really start. If you're a business owner thinking about exit, even if it's years away, this is critical. Let's start with a simple question. When should you plan your business exit? The best time to plan your exit is actually when you start your business. And the reason is simple. Exit planning affects how your business is structured, how much tax you will ultimately pay, what happens to the proceeds, and how much you will end up eventually. The structure you choose on day one, company, trust, sole trader, can make a significant difference between paying millions in tax or potentially none at all. You don't exceed when you want to, you exceed when you're able. Health, buyers, or personal finance circumstances often decide that for you. That's why a well-planned exit isn't an event, it's a strategy. Let me show you what this looks like in practice. Daniel is 61, Wendy is 60. They own 1% of the shares in their trading company, and they have owned it for 16 continuous years. When they sold their business, the asset sold was the shares in the company, largely goodwill. The sale price was $3.2 million. The original cost base was $600,000. That means the nominal capital gain was $2.6 million. Normally, that would be a very significant tax bill. But this is where planning makes all the difference. Because Daniel and Wendy met conditions for the small business 15-year capital gain tax exemption, the result was powerful. The entire capital gain, or $2.6 million, was completely disregarded. No capital gains tax, zero tax payable. This exemption is one of the most generous and underused tax concessions available to Australian business owners. But it only works if your structure, ownership period, and timing line up. What made this strategy even more effective is what happened next. Using the capital gain tax cap rules, Daniel contributed $1.6 million into Super. Wendy also contributed $1.6 million into Super. And here's the key points. The capital gain tax cap is completely separate from your normal concessional and non-concessional contribution limits. For the 25-26 financial year, the lifetime capital gain tax cap is $1.865 million per person. So this strategy isn't just eliminate tax. It shifted a huge amount of wealth into the most tax-effective environments available in Australia. Now this strategy isn't automatic. There are clear eligibility rules. To qualify for the 15-year exemption, you must have owned the business for at least 15 continuous years, be aged 55 or over, sell the business in connection with retirement, and meet the small business tests. That means either aggregated turnover under $2 million or net assets under $6 million. These are not the only conditions, and importantly, not all business owners own their business for 15 years or more. If you own their business for less than 15 years, there's still another option available under capital gain tax small business concessions. Which brings us to the second case study. Jane is 64 and operates as a sole trader. She owned the business for 10 years. When she sold, sale price was $560,000. Capital gain was $400,000. Her goal was simple: to pay as little as tax possible and move money into her super for retirement. If you own your business for less than 15 years, the lifetime limit for capital gain tax retirement exemption, $500,000, can be applied. After applying the 50% general capital gain tax discounts, her capital gain was reduced to $200,000. She then used the capital gain tax retirement exemption to reduce her capital gain tax liability to zero. Under this strategy, $200,000 was contributed to super using the capital gain tax retirement exemption. The remaining $360,000 was contributed as non-concession contributions. In total, the entire $560,000 in sale proceeds ended up in super. While this strategy isn't as powerful as the 15-year exemption, it can still deliver strong outcomes. Once again, planning before the sale makes all the difference. So why do I keep coming back to SuperNation? Because SuperNation offers some of the most powerful tax concessions in Australia. In the accumulation phase, contributions and earnings are generally taxed at 15%. Once you move into pension phase, from age 60, if you retired, or from age 65, regardless of employment status, earnings can be tax-free up to $2 million per person for the 25-26 financial year. The goal with exit planning isn't just to reduce capital gains tax, it's to move wealth into the most tax-effective structure possible for retirement. Let me show you a simple comparison. Peter is 65 and has $2 million in super pension. At a 6% return, that's $120,000 per year, tax payable, zero. John is also 65 and has $2 million invested personally. Same return, $120,000, but after tax, he's left with around $90,000. Same investment, same return, very different outcomes. The biggest mistake business owners make is treating exit planning as something they will deal with later. By the time you're ready to sell, many of the best strategies are already off the table. The earlier you plan, the more control you have, the more tax you can legally eliminate, and the more money you can preserve for retirement. If you're a business owner, even years away from exit, this is a conversation worth having early. If you found this helpful, subscribe for more practical, real-world finance planning insights. To learn more, visit compoundfreedom.au, and I will see you in our next video.